great future. We're talking real money.
Well, welcome to another question and answer Friday. Q&A Friday. At least it's not Freaky Friday or Freakier Friday. I just went to see the Superman movie because there really aren't any good movies in the theaters, but it was closest we could get. And there was a trailer for a sequel to the apparently 1001 Freaky Friday movies. Ow! How I just couldn't bring myself. I could not possibly drag myself into a theater to see that. Do you know how many Freaky Friday movies there have been? First one was in 1976. Since then, there have been a total of 7 of them. We need original ideas, he says as he gets ready to do another question and answer episode, just like every other question and answer episode, except with different questions, many of which will probably be the same as previous questions. That's kind of the way it works. But I am taking your questions. You sent those questions in. You actually spoke them in at talkingrealmoney.com. And I appreciate you doing that as opposed to typing them, because if it wasn't for you speaking them, I wouldn't be doing this episode, and it's one of my favorite episodes. So send those questions in at talkingrealmoney.com. Click the button that says Contact Us, and then you speak them into your computer or your phone or whatever it is. And then I'll answer them on Fridays. The other ones that you type in, they could get answered anytime. We don't know when those are going to get answered. Tom's in charge of that. I'm in charge of these. So call them in at talkingrealmoney.com, or also another great way to talk to us, not better, but great, is to call us on Saturdays when we can have a conversation. We do a show on Saturdays for 2 hours. The phone number for that is 855-935-TALK, and the times, 3 p.m. to 5 p.m. Eastern every Saturday. So, with that said, let's get to what you came here for, the first question.
Hi, Tom and Don. This is Steve from Proctor, Minnesota. Really enjoy your podcast. I listen to it every night. I have a 20-year-old granddaughter who is a college student, and she has a part-time job. I would like to open a Roth IRA for her at Vanguard. I'm looking at VTI or VONG. Or do you have any other recommendations I should put the money in? Thank you.
Yeah, if you're going with one of those two, then you're chasing what has been hot. VTI is the U.S. market. The VONG is the Russell 1000 Growth Index, just the growth part. So you're chasing the stuff that has done well. And this is one of the biggest problems with looking at recent past performance. And by recent these days, that even means a decade, sometimes 15 years. Long-term has become like 20, 25. But you're chasing again after what's been hot. Nothing wrong with either one of those. They're fine investments. But we believe in a higher level of diversification, and we believe in the longest of long-term data, and that's the stuff that goes back, like 100 years. In fact, it'll be 100 years next year. For which we have data. And that leads me to the more long-term, aggressive, yet more diversified portfolios. And by aggressive, I mean it's because they're in segments of the market that aren't in favor today. Great example. We talked about it recently on the show, is the small cap market. Small caps have been unloved for an incredibly long time. However, long-term, small caps have outperformed larger cap stocks. Value stocks have been out of favor in the short term. Growth has been hot. However, value stocks over the long haul have outperformed growth. Now, we're not saying focus entirely on value, focus entirely on small. We're saying have all of them with a little bit more emphasis on the small and the value, since they've shown longer term potential outperformance. Plus, you're also missing international, which we believe is a crucial addition to a properly diversified, aggressive equity portfolio. Again, not because we think you're going to make more money with this. We don't know that. We're not claiming that. But what we do have a high degree of confidence in is the potential for reduction of volatility. And that is the thing that keeps investors invested long term. So our suggestion would be probably going with the value tilted portfolios, small tilted portfolios that come from Avantis and DFA, even though it's for a little more money. See, we're expecting enough in longer term value of the small in value and the value of stability to warrant the slightly higher fees for these funds. It's not like they're hog wild expensive. It's like we're talking 25 basis points versus 7 basis points for Vanguard, but we're still talking pennies now. So that's what I would look at. Again, the others aren't bad, but if I was going to suggest something at Vanguard, it probably would be VT as a single fund, or VT and a little VBR, the small cap value, to get a better diversified portfolio. Thanks for listening. Thanks for your question. And thank goodness we have another one waiting in the wings. Here it is.
This is Andrew. My wife and I currently have $700,000 saved in retirement, HSAs, and brokerage accounts. We currently are 100% equities. I would like to consider putting 17 to 20% of that into bonds and then rebalancing that every year. I'd like to do that in my 401k, and I have the option between a Putnam Stable Value Fund at 0.27 and FXNAX at 0.025. There's also a FM Core Plus commingled pool class 1 at 0.16, but I think I'm leaning towards the Putnam Stable Value. And I was wondering if you guys thought that would be a good idea to use that, or maybe I should go for the bond fund, FXNAX, and have a better chance of a little tiny bit of growth. Also, I was wondering if I should count the brokerage account and the HSA towards that 17% of the 700,000, because those are not necessarily retirement accounts, even though I hope they will be. Any help would be appreciated. Thank you.
Well, it really depends. There's a lot of questions in here. Let's start with the last one. It really depends on the reason you're switching from a 0% bond portfolio to a 20% or so. If you're doing it because you realize that your risk tolerance or your risk need don't require you to take 100% equity kind of risk, then I would probably at least begin to apply it across the entire portfolio, even if you don't buy any bonds in the taxable account, because your portfolio should be looked at as one entity, because odds are almost all of it are going towards retirement. I mean, really, that's the main purpose for which we save both in tax-advantaged accounts and taxable accounts. It's that long term. So, load up your 401k with maybe more bonds and possibly do both, because the Putnam Stable Value has been a very stable portfolio. But the difference is it invests in insurance company contracts. They call them GICs, or guaranteed investment contracts. I personally believe that the G in them is a little misleading, because the guarantee is only as good as the guarantee of the company. It's only as good as the company. I'd rather have a more diverse portfolio, even though there's some volatility. So why not take both? You can put 10% of the total portfolio in one and 10% of the total portfolio in the other, or 8 and 8, or 9 and 9, depending on how much you want to get into fixed income. But I would probably look at least, soon, starting to do it over the whole portfolio, if the reason you're making the change is to improve your risk profile, to reduce the volatility in your portfolio. Thank you for your question. Remember, you can call your question in at talkingrealmoney.com. Just use the contact form and either type it or speak it. The speak it ones go to the Friday podcast, the Q&A podcast, most of the time. Every once in a while, typed one gets in. The typed ones get in when Tom and Roxy do a Q&A Friday show. Oh, and by the way, call Saturdays too when we do the show. we do a regular radio show where you can call us like old radio shows. Remember those? Remember talk shows? Where you call 855-935-TALK. You've heard numbers like that a lot on talk shows. Call blank, 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 TALK, 8255. Well, we're 855-935-TALK every Saturday, 3 p.m. to 5 p.m. Eastern Time. Or you can ask questions anytime at TalkingRealMoney.com. Here is today's final Q and the A to go with it.
Hi, Don. This is Stella from Texas. I have a question about my brokerage accounts. I have two of them, one with Vanguard, which is under their management, and one with Fidelity, which I manage. Vanguard does my tax loss harvest yearly. Can I do tax loss harvest for my Fidelity brokerage account? I'm unsure if tax loss harvest can be done for each of my brokerage account. Thank you.
Stella! Oh, and I'm sure you've never heard that. Yes, you can do and should do tax loss harvesting from both of your brokerage accounts. If these are taxable accounts, then it makes sense to keep an eye out for some losers every year. There may be years where you don't have them, but when you have them, they can be used not only to offset current gains, but they get to be banked to offset. You can offset $3,000 in ordinary income. Then you can carry those losses forward for future gain years. That's why losses are cool. Losses are great. And tax loss harvesting is so easy in portfolios of mutual funds or ETFs because you can almost always find a similar but not substantially identical fund into which you can move, avoiding the wash sale rule. So I would do it in both accounts, and it's pretty easy. You just keep an eye out for losers. You're getting toward the end of the year particularly. Go, anybody down? All right. But again, if you sell a loser, don't turn it into an opportunity to market time. Oh, I'll wait a little while and then I'll get in. No, 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 no. You immediately go to a similar fund. Not substantially identical, which pretty much means they have to have the exact same portfolio. And now, since we're a little short on questions, here is the last one of this episode anyway.
Hey, Don, this is Tyler out in California. Love you guys' show, and I'm learning a lot. Got a question for you about some monies I have in a taxable brokerage account. It's kind of gained over the years. It's probably around $30,000. It's an FBGRX, and I was looking at the fund, noticing it's not that diversified. And so I was trying to see if it'd be more wise to sell this fund off and invest it in something a little more well diversified, such as like an AVGE or DFAW. I just wasn't sure if it's worth the tax implications that I'd have to pay since it is in a brokerage account. Anyways, love to hear your thoughts. Thank you for all you do.
Thank you for listening and participating. This is great. FBGRX, that's the Fidelity Blue Chip Growth Fund, which has got two strikes against it. One, lack of diversification. It's definitely not as diversified as we'd like. Two, it's actively managed. Oh, wait, there's three. It's expensive. It's 0.5% a year, whereas the Avantis or the dimensional funds are less than half that a year. And they're not really actively managed. They're rules-based funds, better diversified with a small value tilt. Now, should you sell and incur the tax hit? Maybe not all at once. You might want to look at how much of a gain you would have. Just simulate your taxes, run some scenarios, and see what it might look like if you sell it all or if you sell a little bit and how big the hit would be. You could spread it out there's no hurry. It's just that I don't think it's an optimal fund for most investors. It's not a terrible fund. I just don't think it's optimal. So I would say, yeah, sell it, but no hurry. But yeah, I think AVGE and DFAW are just all around better possibilities for the future. Thanks so much for your question. And that is going to pretty much wrap up this episode. That's it. Thank you all for being a part of the Q&A show. Every Friday we do some sort of Q&A thing, unless it's a holiday. And please send your questions in at talkingrealmoney.com using the contact form. Call them in on Saturdays at 855-935-TALK between noon to 2 Pacific, 3 to 5 Eastern. And if you need a little help, you want somebody to take a peek at your portfolio and tell you, good, not so good, or just kind of get you on track. We have, since Tom and I started our firm, always provided anyone who asks with some free, truly no obligation, truly no high-pressure sales pitch help. In fact, Tom does a lot of it and loves doing it. To get that kind of help, where we'll sit down with you for half hour, even an hour, just go to talkingrealmoney.com and click on the little button that says Meet an Advisor, set up an appointment, and it's done. And seriously, you don't have to worry that you're getting yourself into something you're later going to regret, because you won't regret it. Okay? All right. Thank you all for being there. Please tell friends, neighbors, and acquaintances. And particularly over the summer when I know you're doing a lot of cavorting and traveling and doing things, tell people about the podcast. More people is better. It's gooder. We like that. I am Don McDonald, your host for this edition of Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.